Welcome back to the Deep Dive. We're here again, taking all those shared sources, the earnings slides, analyst calls, press releases, and boiling them down for you.
That's right. Today, we're digging into MetLife's Q3 2025 results.
We really want to get under the hood, understand what's driving their momentum, and see how that new frontier strategy is actually playing out, especially globally.
Exactly. It's more than just the top-line numbers. We need to see, the structural pieces, the investment choices, making that earning power consistent.
And particularly how they're tackling competitive spots like retirement and capitalizing on Asia. Okay, let's unpack this. So the headline figures, they definitely set the stage. Adjusted earnings, leaving out the notables, hit $1.6 billion.
Or $2.34 per share.
Right, $2.34 a share, which is a 21% jump year over year on that per share basis. That's pretty significant.
It really is, and you see that flowing through shareholder value, right? Look at their adjusted return on equity.
And it's 16.7%.
16.7%, almost the top end of their target range, which is 15 to 17%.
Okay, so that points to solid operational discipline, not just market luck.
Precisely. It's holding up alongside those market-driven gains.
So if that's the result, what was really pushing things this quarter? Let's dive into segment one, investments and efficiency.
Right.
The big surprise seems to be variable investment income, 7.
Absolutely. That was the biggest driver of the beat. 7 came in at $483 million for the quarter.
Which was quite a bit higher than their outlook, right? What was the forecast?
The implied quarterly outlook was around $425 million. So, yeah, about a $60 million beat there.
So that suggests something more than just, good market conditions.
Yeah.
Was it a specific strategy paying off?
It wasn't just luck, no. The performance was really fueled by higher private equity returns. They actually hit 3% for the quarter.
3%, they said.
And that 3% kind of validates their active approach, It suggests they successfully cashed in on some key private funds. It shows their capital markets activity really unlocking value, not just riding the market wave.
And we can see where that capital is focused if we look at the SIFS assets overall.
Right. The total pool is what, $18.9 billion?
Yeah, $18.9 billion.
Yeah.
And the concentration lines up with their strategy, over 40% in Asia.
30% in retirement and income solutions, or RIS.
And about 20% in MetLife holdings. So that capital is sitting right where those big, long-duration global liabilities are.
Makes sense. So the investment income side looks strong and strategically placed. But, high income doesn't mean much if costs are running wild.
Which brings us to efficiency. And that story looks pretty compelling, too.
Their direct expense ratio was 11.6% in Q3.
That's quite a bit under their annual target of 12.1%.
Hey,
They seem way ahead on getting costs down.
They are.
How are they doing it? Is it just replacing old tech, or is there a real competitive edge emerging here? Are they faster now?
Well, they talk about a force multiplier effect from new tech, which sounds like more than just swapping systems. Remember, they invested over $3 billion in the last 5 years modernizing tech. And now it seems that's translating into real productivity gains.
Any specifics?
Yeah, they called out their own AI platform, MetLife MediQ. It apparently mixes generative AI with agentic AI.
Agentic AI, meaning?
Meaning systems that can act on their own, handle complex, multi-step tasks without constant human input. That autonomy seems to be the key to the productivity leap in areas like customer service, app development. It could be a genuine strategic advantage.
Interesting. That AI efficiency angle really sets us up for the next bit. Let's shift to segment 2. Global momentum, retirement, and that surge in Asia. This is where the new frontier strategy is supposed to shine.
And it seems to be. The Retirement and Income Solutions segment, RES, saw adjusted earnings, ex-notables, climb 15%.
So the focus on retirement is definitely paying off.
Clearly. Now, they didn't actually close any new pension risk transfer or PRT deals in Q3 itself.
Right, but they announced something big coming up.
Huge. A record $12 billion in new mandates secured in Q4 to date.
$12 billion. And focused on the jumbo end of the market, as they put it.
Exactly. They're going for scale, not just volume.
And the timing seems perfect, based on their own market research.
Right. Their annual survey showed that 94% of pension plan sponsors aiming to de-risk expect to fully divest within the next 5 years.
Wait, run that by me again? 94%.
94%. A 10-year high, they said.
Wow. Okay, that number basically defines the retirement landscape for the next half-decade. MetLife isn't just grabbing share. They're riding this massive de-risking wave.
And landing those jumbo deals takes serious capital backing. Which leads us to Chariot Re.
Ah, yes, the launch of Chariot Re. Tell us about that.
So it officially launched in Q3. They started with a $10 billion reinsurance transaction.
And the point here is capital efficiency.
Precisely. It's about using third-party capital to expand their capacity for originating these retirement liabilities. It boosts their own balance sheet strength, lets them write those huge deals without overstretching their internal capital.
Here's where it gets really interesting. That use of third-party capital is clever. It really leverages their underwriting expertise without tying up all their own funds.
Smart move.
Okay, shifting globally again, Asia. The performance there was, well, spectacular. Adjusted earnings up 36%.
Yeah, exceptional. Overall sales in Asia jumped 34%, constant currency.
And the main engine there was Japan.
Absolutely. Japan's their biggest market in Asia. Sales surged 31%. And it was really driven by new retirement-focused products, things like single premium FX life, yen variable life, plus they enhanced their existing FX annuity.
So product innovation meeting market demand.
Exactly. And it wasn't just Japan.
Right. Other Asia was up 39%.
Led by strong results in Korea and China. Real broad-based strength across the region.
We should probably touch on Latin America, too. Seems like there's good momentum there as well.
Definitely. Adjusted PFOs, that's their premiums, fees, and other considerations metric. Basically, top-line sales were up 11% constant currency. Good growth in Mexico, Chile, Brazil.
And the digital side is contributing. That accelerator platform.
Yeah, it's expanding quickly. They just inked a new partnership with Mercado Libre, the e-commerce giant, in Mexico and Brazil.
Wow. Mercado Libre is huge there.
It is. And since launching, Accelerators generated over $340 million in annualized premiums, now has more than 20 partners. It's becoming a serious channel.
Okay. Anything else on LODAM? There's a small note about a charge.
Ah, yes. Just the small clarification needed there. They took a temporary $71 million after-tax charge in Q3. It relates to an industry-wide VAT issue in Mexico.
Temporary, meaning?
Meaning they expect it to normalize pretty quickly by 2027. They're basically adjusting pricing on new annually renewable products to recover that cost over time. So think of it as a short-term headwind, not some structural loss.
Got it. Yeah. Makes sense. Okay, let's wrap things up with segment 3, capital, risk, and those upcoming structural changes. Starting with capital management, seems like they're keeping a tight rein.
Very disciplined. They focus heavily on value of new business, VNB. That's the expected profit from new policies.
And how did that look in 2024?
They put $3.4 billion of capital behind new business, and they achieved a very attractive 19% internal rate of return.
19% IRR. And a quick payback.
Just 5 years. That shows really strong capital stewardship, getting good returns quickly.
And their cash bucket looks solid, too.
Oh.
Holding company cash was $4.9 billion.
Yep, $4.9 billion, well above their target buffer of $3 to $4 billion.
And shareholders saw a good chunk of that return, $875 million in Q3, between buybacks and dividends.
Right. $500 million in buybacks, $375 million in dividends.
Okay, let's talk risk and underwriting. They mentioned credit spreads being tight.
Yeah, stable fundamentals, but spreads are, as they put it, priced for perfection.
Priced for perfection. That sounds like a warning sign in this environment. So how does MetLife navigate that, especially with their up-in-quality bias? Are they pulling back on private credit?
They stress they're maintaining that quality bias, and here's the interesting part. They really rely on their own underwriting discipline for private credit. They're not just depending on rating agencies.
So they trust their internal homework more.
Seems like it. It means they can be picky, walk away from deals if the risk-reward doesn't meet their standards, even if the market loves it. They pointed to their commercial mortgage loan portfolio as an example of quality.
What are the stats on that?
It's a $45 billion portfolio, still looks very strong. Average loan-to-value is low at 39%, and the average debt service coverage ratio is healthy at 2.1 times.
Okay, solid underlying quality there. Finally, let's cover the structural shifts on the horizon. 2 big deals closing soon.
Yeah, both expected in Q4. The acquisition of PineBridge and the sale of that legacy variable annuity block to Talcott Resolution Life.
And a change in reporting structure, too.
Right, starting Q4. MetLife Investment Management, MIM, gets its own reporting segment, and MetLife Holdings gets rolled into corporate and other. It just aligns their reporting better with that new frontier strategy.
Makes sense. And internationally, Japan's moving to a new regulatory regime. Any update there?
That's a key long-term point. They expect to report their economic solvency ratio, the ESR, within a strong range of 170% to 190% by March 2026.
So, well capitalized under the new rules.
Exactly. Confirms the strength and efficiency of MetLife Japan going forward.
Okay, so pulling it all together for you listening, Q3's narrative seems to be driven by, well, three main things. First, that exceptional variable investment income, boosted by smart private equity moves.
Second, real operational efficiency, looking like it's genuinely accelerated by AI.
And third, clear strategic execution wins, especially that record pipeline in PRT and the really strong sales growth across Asia led by new products.
If we connect this to the bigger picture, I think these results really underscore their ability to deliver, all-weather performance. It seems driven by consistent strategy and tight cost control. Even with market ups and downs, they're generating solid value globally.
Absolutely agree. The momentum in retirement, those PRT wins, it's really something.
Yeah.
But that huge market opportunity they flagged, that 94% of plan sponsors looking to divest soon, leaves us with a final thought for you to chew on.
What are the long-term risks, or maybe opportunities, of relying so heavily on the jumbo end of the market for PRT? Does concentrating on just the biggest deals introduce potential volatility down the line if those deals ebb and flow? Something to consider as they head into this record Q4 for mandates.